Most of us were taught that the Federal Reserve was born out of a crisis, that in 1907 the American banking system nearly collapsed, that panic tore through Wall Street, and that Congress, having finally learned its lesson, built a central bank 6 years later so that it could never happen again. Reform arriving late, but arriving. It is a clean story. Most of the facts inside it are even true, but it leaves out the detail that explains everything else. Because in October 1907, the United States already had a lender of last resort. It was not an institution. It was a 70-year-old private banker standing in his own library on Madison Avenue, deciding which banks would be saved and which would be allowed to die. He saved the system. That is what frightened Washington. I am not here to tell you that a group of bankers secretly seized control of American money. That story exists, it sells extremely well, and we are going to look at it directly because it grew out of something real. What I am here to tell you is stranger, and I think more uncomfortable. The Panic of 1907 did not produce the Federal Reserve because America lacked a central bank. It produced the Federal Reserve because America already had one, and it was private, unelected, and mortal. Its name was J. Pierpont Morgan. Everything that follows comes from the problem of replacing a man with an institution, and from the fact that the people best qualified to design that replacement were exactly the people the public would never accept as its authors. Before this is over, this story will pass through a locked library door and a key in a banker's pocket. It will pass through a president who approved one of the largest mergers in American history in a few minutes, standing up before the stock exchange opened. It will pass through a private island off the coast of Georgia, where 6 men traveled as duck hunters and agreed to call each other only by their first names. It will pass through a trust company president who shot himself at an institution that reopened 5 months later. And it ends with an emergency currency that reformers dismissed as a joke, which worked, and a central bank that everyone called the solution, which failed at the one job it was built to do. So let's go back, not to 1913, and not even to 1907, but to 1836. And the last time Americans deliberately destroyed a central bank. The United States had tried central banking twice and killed it twice. The first Bank of the United States lost its charter in 1811. The second bank lost its war with Andrew Jackson, and its federal life ended in 1836. After that, for 77 years, the country that would become the largest economy on earth ran with no institution whose job was to supply cash when cash ran short. That is the central fact of American finance in the 19th century. In 1863 and 1864, in the middle of the Civil War, Congress built the national banking system. It was an elegant piece of war finance. National banknotes could be issued only against United States government bonds deposited in Washington. That made an important part of the currency supply slow to expand at exactly the moments when demand for cash rose fastest. In a farming economy that mattered enormously, every autumn the crops came in, every autumn country banks pulled their deposits out of New York to pay farmers in cash. Every autumn the New York money market got thinner, rates rose, and the whole system leaned closer to the edge. The currency was inelastic. The harvest was not. So America had panics on a schedule. 1873, 1884, 1890, 1893. That is the part of the story that gets left out of the textbook version, and it changes the meaning of everything that follows. The Panic of 1907 was not an aberration in a stable system. It was the 5th appointment kept by a system that had been designed, quite deliberately, to be unable to breathe. And where the public system was absent, private ones improvised. The New York Clearing House, an association of the city's banks, could issue loan certificates in an emergency, a kind of private paper that member banks used to settle with each other instead of cash. It was a central bank in everything but name, run by the banks themselves, with no charter, no mandate, and no obligation to anybody outside the room. By 1907, there was a second problem, and almost nobody in Washington had noticed it. Here is where the story gets strange. The institution that broke in 1907 was not a bank. It was a trust company. And trust companies were the shadow banking system of their day. They had begun as conservative managers of estates and wills. By the turn of the century, they had become something else entirely. Aggressive lenders that took deposits, financed stock speculation, and competed directly with national banks for the same customers. What they did not have was the same rules. A national bank in New York City was required to hold 25% of its deposits in cash reserves. A trust company held roughly 5%. Between 1890 and 1907, the assets of American trust companies grew by 244%, from roughly $397 million to about $1.4 billion. Over the same period, national bank assets grew by 97%. The lightly regulated sector was expanding at more than twice the speed of the regulated one, doing bank-like business on a fifth of the cash. Most trust companies were also not full members of the New York Clearing House, so the private emergency machinery that had substituted for a central bank for 40 years did not automatically reach them. The economists John Moen and Ellis Tallman have built much of the modern understanding of this, and their central point is precise. The panic of 1907 was not a rerun of the older bank panics. It happened in the part of the financial system that the existing safety net did not cover. That distinction is going to matter again, about a century later. On October the 16th, 1907, a copper speculator named F. Augustus Heinze tried to corner the stock of the United Copper Company, squeezing short sellers by buying up the available shares. The scheme collapsed within a day. By itself, that is a minor story. Rich men lost money on a bad trade. What made it catastrophic was who Heinze knew. He was tied to Charles W. Morse, a financier whose interests ran through a web of New York institutions. Morse directly controlled 3 national banks and sat on the boards of several others. When the copper corner failed, depositors began asking a very simple question. Whose money was inside those banks, and where had it been lent? On October the 18th, the newspapers reported that Charles T. Barney, president of the Knickerbocker Trust Company, had business ties to Morse. The Knickerbocker was not a marginal firm. Under Barney, its deposits had grown from $11 million to more than $65 million. It was the 3rd largest trust company in New York. On October the 21st, the National Bank of Commerce announced it would stop clearing checks for the Knickerbocker. The Knickerbocker had lost the institution that cleared its checks, a public signal that one of New York's largest trusts might no longer be able to meet ordinary payments. The next morning, the queue outside its office ran down the block. Within hours, the Knickerbocker paid out roughly $8 million in cash. Then it stopped. It suspended operations on October the 22nd. Call money, the overnight cash that funded stock positions on the New York Exchange, had been trading around 9.5%. On October the 22nd, it hit 70%. 2 days later, it touched 100%, and for stretches of that day, there was no money to borrow at any price at all. An interest rate of 100% is not a price. It is a scream. J. Pierpont Morgan was not in New York when it began. He was in Richmond, Virginia, at a church convention. He came back on a night train. He was 70 years old. He held no public office. He had no legal authority over anyone, and for the next 3 weeks, he ran the American financial system. His first move was triage. He sent teams of young bankers into the books of the institutions under attack to find out which were genuinely insolvent and which were merely out of cash. One of the men he used was a vice president at Bankers Trust named Benjamin Strong, who spent a night working through the Knickerbocker's accounts. Remember that name. Strong would become the first head of the Federal Reserve Bank of New York and the most important central banker of the 1920s. The verdict on the Knickerbocker was that it could not be saved in the time available. Morgan let it fall. The Trust Company of America, with nearly $60 million in deposits, he decided to defend. Over the following days, that firm paid out roughly $47.5 million across its counters, and it survived, because the cash kept arriving. Where the cash came from is the part that matters. The Treasury Secretary, George Cortelyou, came up from Washington and deposited $25 million of government money in New York banks on October the 24th. Across the last 10 days of October, the Treasury placed roughly $37.6 million and shipped about $36 million in small bills so that banks could physically pay depositors over the counter. John D. Rockefeller put $10 million into the Union Trust Company and told the press he would pledge half his securities to hold the credit of the country. The clearinghouse went back to its old trick, issuing roughly $110 million of loan certificates in 3 weeks. Counting every improvised substitute for currency across the country, something close to $500 million of unofficial money went into circulation that autumn. The federal government was depositing public money into private banks and asking a private banker to decide where it went. The Treasury had cash and no mechanism to lend it. Morgan had a mechanism and no cash. The rescue worked only because a private man and a public purse were briefly welded together in a library on 36th Street. Then came the 2 decisions that made him legendary and made him hated. By the first days of November, the city of New York was close to default. It could not sell its bonds. Morgan bought $30 million of them. And on the night of Saturday, November the 2nd, he summoned the presidents of the trust companies to his library. The brokerage house of Moore and Schley was about to fail, and the collateral behind its loans was stock in the Tennessee Coal, Iron, and Railroad Company. If the firm went down, that stock would be dumped, and the collapse would spread. The bankers argued for hours. By 3 a.m, roughly 120 financial men were inside the building. At some point in the night, they understood that the doors were locked and that Morgan had put the key in his pocket. The solution he wanted was that United States Steel, a corporation he had assembled 6 years earlier, would buy Tennessee coal and iron, turning doubtful collateral into solid securities. There was one obstacle: It was plainly an antitrust problem. So Henry Clay Frick and Elbert Gary took an overnight train to Washington and were shown in to President Theodore Roosevelt before breakfast on Monday, November the 4th. Roosevelt, the trust buster, approved it on the spot. He wrote afterwards that he had to decide on the instant before the stock exchange opened. The market opened without the cascade Morgan had feared. The acute phase of the panic began to ease, although the economic damage was only beginning. Now let's talk about something the conventional narrative gets badly wrong. The rescue is usually told as a triumph, and it was won. That is precisely why it terrified people. The stability of the American economy had rested on the judgment, the reputation, and the personal solvency of one 70-year-old man, not on a law, not on an agency, on a man in a room with a key. And the rescue carried a price. United States Steel had absorbed a significant competitor with a president's blessing in the middle of an emergency. Whether that was a rescue or an opportunity is still argued over, and it should be. The fact that the question cannot be cleanly settled is itself part of the problem. There were human bills as well. On November the 14th, 1907, Charles Barney shot himself at his home on East 38th Street. He died that afternoon. He had not, in fact, been ruined. His estate was later reckoned at some $2.5 million. The Knickerbocker Trust Company reopened in March 1908 after raising $2.4 million in fresh capital. He killed himself 5 months before the institution he was blamed for came back to life. The wider economy took the blow anyway. Depositors pulled more than 36% of their money out of New York trust companies between late August and the middle of December 1907. Industrial output fell 17% in 1908. Real gross national product fell by about 12%. The recession was short by the standards of what came later. It was not short for the people inside it. The political reaction was immediate. If the country was going to be rescued by Wall Street, Congress wanted to know who Wall Street actually was. In 1912, the House Banking and Currency Committee, under Arsen Pujo of Louisiana, opened the money trust investigation. Its counsel, Samuel Untermeyer, laid out a map of interlocking control. 180 individuals holding 341 directorships in 112 corporations, with aggregate resources of some $22.2 billion. The report found that the 20 largest banks held close to 43% of the country's banking resources. Morgan testified in December 1912, and the exchange that followed became part of the story every biography tells. Untermeyer pressed him on whether commercial credit rested on money and property. Morgan's answer became the most quoted line of his life. The first thing he said is character. He sailed for Europe soon after. He died in Rome on March the 31st, 1913, 9 months before the law that replaced him was signed. Congress had responded to 1907 in 2 steps. In May 1908, it passed the Aldrich-Vreeland Act, which did 2 things. It authorized banks to issue emergency currency in a crisis, and it created the National Monetary Commission to study how other countries handled the problem. The chairman of that commission was Nelson Aldrich, Republican senator from Rhode Island and chairman of the Senate Finance Committee, by any measure the most powerful legislator in the country on financial questions. He was also, since 1901, the father-in-law of John D. Rockefeller, Jr. Aldrich had spent his career opposing central banking. Then the commission took him to Europe, where he watched the Bank of England, the Bank of France, and the Reichsbank absorb liquidity shocks with a discount window and a signature. Elmas Wicker, whose book The Great Debate on Banking Reform is the standard modern account, documents that conversion carefully. Aldrich came home convinced America needed the same machinery. And there was a second thing he saw in London that rarely makes it into this story. American banks in 1907 could not finance international trade in dollars because the country had no acceptance market and no institution standing behind one. An American exporter borrowed in sterling through London and paid a British bank for the privilege. The political scientist J. Lawrence Brose has argued that this was a serious driver of reform in its own right. The ambition to make the dollar a currency the world would settle in. On that reading, the coming fight was never only about stopping panics. It was about position. The difficulty was that Aldrich had no idea how to build the machine. So in November 1910, he assembled people who did. On the night of November the 20th, a private railway car left a station in New Jersey. Its passengers had arrived separately, at intervals, carrying shotguns. The cover story was a duck hunting trip. The destination was the Jekyll Island Club, a private retreat off the coast of Georgia owned by a group of millionaires and closed for the season. 6 men were on that car and on that island. Nelson Aldrich, the senator, Abram Pyatt Andrew, an economist and assistant secretary of the Treasury, Arthur Shelton, Aldrich's private secretary, Henry Davison, a partner at J.P. Morgan and Company, Frank Vanderlip, president of the National City Bank, And Paul Warburg, a German-born partner at Kuhn, Loeb and Company, who had published an essay on the defects of American banking in January 1907, 9 months before the panic proved him right. They agreed to use only first names so that the club's staff could not identify them. Vanderlip and Davison went further and traveled under false ones. Vanderlip later remembered Benjamin Strong being there as a seventh man, but most historians conclude that Strong did not attend. What is not disputed is the secrecy, and what is not disputed is the output. For about 10 days, in a closed clubhouse, 6 men wrote the blueprint of an American central bank. They called it the Reserve Association of America. One institution with 15 branches across the country, holding member bank reserves, issuing currency, discounting commercial paper, and clearing checks, with member banks electing its directors and the larger banks holding more vote. Writing his memoirs a quarter of a century later, Vanderlip said he had felt as furtive as any conspirator. That is his own word in his own book, and the conspiracy literature has been quoting it ever since. So, let me be careful here, because this is the exact point where the story usually goes off the rails. The secrecy was real, the men in the room were real, their institutional interests were real. What the record does not support is the idea that the meeting was a hidden coup that succeeded, because the Aldrich plan failed. It was published in 1911 with Aldrich's name attached, and the name was fatal. Aldrich meant Wall Street, and Aldrich meant the Rockefellers. Critics argued the structure would let the New York banks control the country's credit and rig the system in their favor. The Democrats made opposition to the Aldrich plan a plank of their 1912 platform. They won the presidency and both houses of Congress. The plan died. That is the fact around which the most popular version of this story falls apart. G. Edward Griffin's book, The Creature from Jekyll Island, published in 1994, has probably shaped more public belief about the Federal Reserve than every academic history of it combined. Its factual spine, the meeting, the secrecy, the participants, is broadly accurate. Its conclusion, that a banking cartel captured American money in a single stroke on a private island, is not what the record shows, for the plain reason that the island's plan was rejected by Congress. But I want to be fair about why that book lands so hard. It lands because the respectable version of this story spent decades pretending the meeting never happened. Aldrich denied it. The participants said nothing for more than 20 years. When Vanderlip finally described the trip in 1935, he described it as a secret because it had been one. If you hide the origin of an institution, you do not protect it. You guarantee that on the day it surfaces, it will look exactly like a conspiracy. What passed instead was drafted by Carter Glass, a Democratic congressman from Virginia, and H. Parker Willis, the economist who advised him. Their bill deliberately broke the single institution apart. Not one central bank with branches, but 12 regional reserve banks, each with its own board. Woodrow Wilson added the condition that made the thing politically survivable, a Federal Reserve Board in Washington appointed by the president and sitting above the regional banks. The Federal Reserve Act was signed on December the 23rd, 1913. Here is the honest summary, and it satisfies nobody. The technical machinery of the Federal Reserve came out of the Jekyll Island work. The political architecture that governs that machinery was built specifically to defeat the men who wrote it. Paul Warburg spent years complaining that the 12-bank structure was a mistake and that it left the system weaker than it should have been. The bankers designed the engine, the politicians designed the cage, and then the bankers were told to get inside it. That contradiction is why historians still divide over what 1913 actually was. The orthodox account, which you will find in Wicker and in Roger Lowenstein's History, America's Bank, treats the Federal Reserve as the product of a genuine technical failure, an inelastic currency, recurrent panics, and an ordinary political struggle that ended in a compromise nobody designed. The revisionist account, argued most forcefully by the economist Murray Rothbard, reads the same evidence differently. On this view, the largest banks did not fear regulation. They wanted it, because a legally protected reserve system would socialize the risk of their own expansion. Rothbard's critics answer that he understates how much the bankers actually lost in 1913, and that a cartel which spends 3 years fighting the final bill is a very strange sort of cartel. But before deciding whether the compromise worked, we need to test both systems against the next two crises. Remember the Aldrich-Vreeland Act of 1908, the temporary measure that let banks print emergency currency? Reformers treated it as a stopgap and something of an embarrassment, the sort of half measure you pass when you cannot pass a real law. In August 1914, the First World War broke out. European investors dumped American securities. The New York Stock Exchange closed for months. By several financial measures, it was an even larger external shock than 1907, and the Federal Reserve did not exist yet. The act had been signed. Its banks had not opened. So the Treasury invoked Aldrich-Vreeland. Banks issued roughly $386 million of emergency currency, peaking at about $364 million outstanding in late October 1914, and retired essentially all of it by the middle of 1915. There was no general banking panic. The comptroller of the currency observed that banks had maintained payments across the entire country, something they had failed to do in 1893 and again in 1907. The stopgap worked. The Federal Reserve banks opened for business on November 16, 1914. Paul Warburg had been sworn onto the first board that August. He served 4 years. In August 1918, he left it under sustained public attack for his German birth and for his brother Max, who ran the family bank in Hamburg and advised the German government. The man who had done more than anyone alive to design the American Central Bank was driven out of it by a war, and then came the real test. Between 1930 and 1933, roughly 9,000 American banks failed. The money stock fell by about a third. The Federal Reserve, the institution created precisely to be the lender of last resort in exactly that situation, did not act as one. Milton Friedman and Anna Schwartz built an entire monetary history of the United States around that failure, and Ben Bernanke, decades before he ran the place, built his early academic career on the same question. In 1907, a private banker with no legal authority stopped a panic in 3 weeks. In 1931, a public institution with full legal authority watched thousands of banks die. I am not telling you that Morgan was better than the Federal Reserve. He allocated credit to his friends, he profited from the rescue, and no republic should depend on one man's mood. I am telling you that the problem those 6 men went to an island to solve was harder than they believed, and that building the machine turned out to be a smaller achievement than knowing when to pull the lever. It is worth remembering what all of this looked like from the other side of the counter. A panic is not an argument about reserve ratios. It is a man standing in a queue on a cold morning with a passbook in his hand, working out how many days of rent he has left if the doors shut before he reaches them. That is why the Treasury shipped small bills in 1907 rather than large ones. Somebody in Washington understood that a depositor who is handed his money in 5s and 10s goes home, and a depositor who is turned away tells his neighbors. Every reserve requirement, every discount window, every emergency statute in this story exists to manage that one moment at the front of the line. In 1907, a private banker managed it. In 1931, nobody did. And this is where it stops being history. In 2008, the failures that nearly took the system down again were concentrated outside the regulated banking core in institutions that borrowed short and held long, the trust companies of their generation. And again, the rescue was assembled in improvised weekend meetings by a small number of people who had not been elected to anything. A century after Moen and Tallman's trust companies, the break came through the same seam. Now, let me bring all of these threads together, because the chain from 1836 to the present is tighter than it looks. A country destroyed its central bank, then tied a large part of its paper currency to federal debt, leaving the supply of national banknotes unable to expand quickly enough when the harvest demanded cash. That helped make recurring panics a feature of the system. Recurring panics forced private banks to build their own emergency machinery, which answered to nobody and did not cover the fastest growing part of the system. That uncovered part, the trust companies holding 5% reserves against the national bank's 25, grew until one failed copper trade could break it. When it broke, the only body capable of stopping the collapse was a private partnership, so the Treasury handed public money to a 70-year-old man and let him allocate it. He succeeded, and his success proved that the United States had quietly outsourced its financial sovereignty to a man with a heart condition. So the country built an institution to take the job off him. And then it learned that the design had never been the hard part. In 1914, the emergency law everyone despised held the line. In 1931, the institution everyone had celebrated did not. The next time someone tells you that the Federal Reserve was created in secret by bankers on a private island, you will know how to answer. And the answer is not a simple yes or no. The answer begins with yes. 6 men did meet in secret on Jekyll Island in November 1910, and what they wrote there was the working blueprint of an American central bank. But the answer also requires a no, because the institution those 6 men designed is not the institution that governs American money today. Their names on the bill were enough to kill it, and the law that finally passed was deliberately built to constrain them. Both are true. And the second only exists because of the first. What actually happened in those 6 years is simpler and heavier than either version. A country discovered that its financial stability was the private property of one aging man, decided that this was intolerable, and could not find a way to take the job back that did not involve asking him and his rivals to design the replacement. That is not a conspiracy. It is what happens when expertise and legitimacy live in different rooms. Follow the money, and it does not lead to a smoke-filled conspiracy. It leads to a locked library, a private railway car, and a compromise that nobody in the room was happy with. Every institution has an origin story it would rather not tell. This one told nothing at all for a quarter of a century, and it has been paying for that silence with 100 years of suspicion it can never fully answer. The panic was stopped by a private man. The blueprint was written by private men, and what was signed in 1913 was a country trying imperfectly and half-blindly to take that power back. If this is the kind of history you want more of, subscribe. This channel follows the money underneath the events you were taught to explain some other way, and there is a great deal more of it. And tell me in the comments which of these you think mattered most. The inelastic currency of 1863, the 5% reserves of the trust companies, the secrecy at Jekyll Island, or the 12-bank compromise of 1913. I read every single one. If you got something out of this, a like genuinely helps this channel reach people who were only ever taught the clean version.